Today we will give some love to our neighbors in the north and look at a Canadian income ETF. The ETF is called Hamilton Enhanced Multi-Sector Covered Call ETF, ticker symbol HDIV or HDIV. And just like investors from the States, Canadian investors love monthly dividend payments as well. HDIV is very unique in that it owns ETFs that themselves are covered call ETFs. It's like income ETF inception of a covered call ETF within a covered call ETF. HDIV currently has around a 9.7% yield. Run by Hamilton ETFs, their motto is delivering you more income every month. Now that's a language we can all speak and get behind. Though I hear English is also supposedly spoken in Canada too. HDIV's goal is to provide attractive, I'm sure they're not talking about looks here, monthly income and long-term capital appreciation for my diversified, multi-sector portfolio of primarily covered call ETFs focused in Canada. The ETF has actually outpaced the S&P TSX 60 by nearly 5% since its inception. What the Canada is the TSX. The S&P TSX 60 index is a stock market index of the 60 largest companies listed on the Toronto Stock Exchange. It's similar to the S&P 500, which is the biggest companies in the United States. It's a quick way to gauge the general performance of the country's largest public companies. HDIV gives broad diversification similar to that of the TSX 60. It has potential for growth, and it offers a higher yield than most traditional ETFs or index funds. Now this is a newer ETF, only being established in July of 2021, and it has just $274 million in assets under management. That's in Canadian dollars, by the way. One Canadian dollar is about 75 cents in US currency at today's exchange rates. They're also audited by KPMG, arguably the most prestigious auditing company in the world. Shout out to all my fellow auditors out there. How cool is it that they list who audits them? Integrity is always important. HDIV charges a 65 basis point management fee, so that will be $65 in fees for every $10,000 invested every single year. Now that's going to be money taken off the top, so regardless if the ETF actually ends up in the green or in the red, that expense ratio is being paid. But on the flip side, they hold 7 different covered call ETFs in various sectors. This is broken out by energy giants, Canadian banks, Canadian financials, gold producers, utilities, healthcare, as well as technology. So while on the surface it may look like there's only 7 holdings, in reality, one is owning hundreds of different companies because these 7 ETFs are invested in various sectors and each holding dozens of companies apiece. And despite its Canadian origins, only about 1/3 of its holdings are actually held within Canada. So we're still getting pretty good geographical diversity. These days it's going to be really hard to find investments that can keep up with the ridiculous 8% inflation. People don't realize how much of their wealth they're losing with inflation being that high. Now what I really like about their portfolio breakdown is they got several different companies and fund managers and strategies going on, but really the objective is going to be the same for all of them, to get you those dividend checks every single month. So we have very reputable companies like BMO, Harvest, Hamilton investing in Hamilton. So while it's possible certain covered call strategies they may not do so hot, we have better odds with 7 different funds working hard for us. The fund is also cash leveraged 25%, which essentially just means they are practicing a strategy of using borrowed money to increase their potential returns. So if the market goes up or down 10%, HDIV will actually move 12.5%. Now we know covered call funds generally don't do so hot in a bull market since the calls they're writing are giving up potential upside, so this is a way to get a little upside back. But also know that when the market doesn't do so hot, those losses will also be amplified. As interest rates continue to rise, that means borrowing cost of money is also going up, and that will also eat into our returns. This is just another way that HDIV is a little bit different, and also another risk factor you need to consider when doing your own research. HDIV has done a nice job of paying monthly dividends since its inception in the summer of 2021. It also more or less pays out the same amount each month rather than random distributions, and has had one increase so far. Year to date, the fund is down just under 11%. Factoring in dividends, it's actually only down about 2%, which isn't bad considering how awful the market has been in 2022. It's also been on par with JEPI, which is down about 12% year to date, and that would also be around 2% when factoring in dividends. And I know how much y'all love the ETF that is JEPI. Taxes are hard enough to understand in the US, so trying to make sense of them from another country should really be talked about with a tax professional. Though just a quick snippet from their company website is that distributions from covered call ETFs generally include eligible dividends, capital gains, foreign income, and a return of capital in their distribution component. This is going to change year to year on how that composition will look like. Distributions shouldn't have withholding taxes, as those have already been paid by the underlying securities. HDIV is actually on the Toronto Stock Exchange. You may have some difficulty finding the ticker on your particular brokerage if you don't live in Canada. Now, after some discussion with Fidelity Customer Service, I found I was able to find the ticker on their brokerage by putting in HDIV:CA. I also have international trading enabled on my account, so see if you need to do that before being able to find this ticker. Not liking this near 10% yielding investment? Luckily, I just made a video on another company that gives a mouth-watering double-digit dividend payment in Ares Capital. I'll link it at the end of this video. Let me know what your thoughts on HDIV are. They seem like a really powerful investment tool for those who want some exposure to Canada's economy. It's always nice to be diversified across several different ETFs and asset classes. My videos are always found in podcast form under the Collect Cash podcast name, and I'm out. I'm out.